It's been a tough year for sure, and because I'm not above using cliches, I'm a sailor and we listen for foghorns and bells to navigate our course through the fog. May has been almost as difficult as any other month this year, right? But we're confident that the fog will begin to lift some this year and that we should be able to see some economic growth and stability and positive market returns in the last quarter. I'm Eric Powers with Sky Blue Wealth, and we'll go into this video as we normally do with a monthly recap to touch upon the economy, markets, and portfolios. So let's start with the economy. As you're well aware, inflation is the number one concern of probably you and most Americans. It is real, but it's hardest hitting our food and fuel sectors. Consumers continue to consume. We're driving demand. And if you think of the supply-demand curve, where even though it's called a curve, it's more of like a seesaw, supply simply can't keep up. And that's what's being called the supply chain bottleneck. So if supply and demand cannot keep up, something is going to break. So what's being done in order to control this? Well, first of all, the Fed. The Federal Reserve Bank is responding to price stability. That is one of their core objectives, is price stability or controlling inflation. So to combat that, what they've done so far and what we expect that they'll probably continue to do through the end of the year is raise rates. So far, we've seen rate raises. We expect it in June and July as well, each of which would probably be about 50 basis points. And then we see maybe there will be a pause. And then they'll look around and they will navigate themselves to see what they need to do next, and then very likely we're going to see a couple more rate hikes before the end of the year, more to the tune of 25 basis points or 0.25% each of those months. In addition to combating inflation with raising interest rates, they're also going through something known as quantitative tightening. We've talked about this here before on this channel, but basically what has happened is the Federal Reserve has bought a ton of bonds during COVID to help provide stimulus. Now they're on the selling end of things, and they'll be putting those back out into the market. This is also known as running off the balance sheet or reducing the Fed's balance sheet. Doing these things, their hope is that they'll be able to bring inflation down in the second half of the year. It takes a while for this to work through the system though. And while they're doing this, they're also having to uphold their other commitment, which is jobs. The difficulty here is that the unemployment rate is already very low. We need more people to come back to work. So what they have is a balancing act. They have to avoid hurting business growth, and they have to be able to control demand. They have to be able to tamp down demand to meet the lower supply. If they can do this, and if they do it successfully, then hopefully we avoid a hard landing of a recession. So on the topic of a recession, recessions can happen without a crisis occurring. So a mild recession, even our outlook which says it might not occur until 2023, is part of the business cycle. We plan for things like this, right? We just don't know when or to what extreme they're going to go. All right, so let's turn our focus for a moment over to international issues. All right, specifically talking about China and Russia. China is the primary cause of the supply chain bottleneck we were talking about. Due to their longer and more dramatic shutdowns due to COVID, their economy is very likely going to grow slower than ours this year, which is actually very highly unusual. They usually grow much faster than us. But on the topic of China, we also consider what are the threats to the U.S. economy. So one is they are still making trading relationships around the world outside of the U.S. They're building those relationships up. They're also building up their military. Their military is continuing to strengthen, and they have a younger workforce than ours. When we talk about Russia, it's obvious that what we're talking about here is the uncertainty that's being caused by the war in Ukraine. Their economy is being squeezed by sanctions, the ruble is taking a hit, and they're not in great shape. However, they still pose a threat to the United States and to our economy. The primary pressures are in Europe and through the energy supply. However, as much as we may want to think that these are hurting them, they still do pose threats to the US economy, even though they may be somewhat indirect. So let's think for a moment. They are putting pressure on Europe, and Europe's energy supply specifically. That does affect us. It certainly has a ripple effect. They do have a willingness to use force in order to be able to disrupt stability, economically, geopolitically, etc. So as far out on a limb as we could go, talking about geography and politics, let's instead keep our focus and come back to markets. So remember, as investors, we are invested in revenues and earnings of companies. What we're seeing is a shift. There is a shift occurring right now that as we consumers continue to spend, we're shifting how we're spending our money. We're spending it less on goods and we're spending it more on services. Think about it this way. Have you booked a vacation? Have you traveled recently because you didn't travel during COVID? So let's think about bottoming. The market, as we know, has fluctuations, has volatility, has ups and downs, peaks and troughs, and big swings. But could we be bottoming? So what is it that we really watch for in bottoming? We watch for big swings in either direction. Lots of buys, lots of sells, the market's up, the market's down dramatically in a very short period of time. We see panic selling. Analysts specifically look for panic selling. They're watching to see if, people get freaked out, if investors are freaked out and they sell at a loss. These are signs that we could be bottoming. If we avoid a crisis, meaning if we avoid companies going bankrupt, we could have a mild recession or possibly even no recession. Now, recovering from losses from the bottom of the market, with no recession, we could have a pretty quick recovery of, let's say, 7 months. Now, if we do have a recession, the statistics are a little bit different, and it could be about 1.5 years before we get those returns. So being an optimist, we could see a second half recovery to market highs. If earnings and revenues hold, and they remain overall strong, we have a couple of opportunities. One, valuations have dropped. The companies, the stocks that we had bought before are now selling at a discount. So we buy the dips. Who buys the dips? Who have we heard? Warren Buffett. He's buying the dips as we speak. Perhaps everything that we've experienced so far isn't necessarily a major crisis, and it isn't necessarily something that we have to worry about a recession. It's just a growth scare. When we look at valuations and which have been hurt the most, we look really at the big tech companies. They're the ones that have taken the biggest hit, and they look the cheapest on paper right now. So perhaps all of this is really nothing more than a growth scare, as opposed to tipping into a recession event. Take comfort, though, in the markets, that if and when we go into a bear market, we always come out of it higher. I've been told by somebody that in these videos, I'm supposed to put something in about myself, a little personal note. So as I mentioned, I'm a sailor, and as I opened with, I talk a little bit about sailing. But here's my background in sailing, and it's a whole lot of fun. I wish I could do it full time and make money at it. But I've been sailing my entire life. During my high school summers, I used to sail at a resort in Maine. I used to teach sailing there as well. And when I got engaged to my wife, we lived out in San Francisco, and I used to race competitively in the midwinter races there. Over the past several years, I haven't really had access to a sailboat or to the water as closely. So instead, I got an RC, a radio-controlled sailboat, and that's been some fun. Lately, I've turned my attention to rehabilitating a mahogany sloop that my family's owned for years, and it just hasn't been used. Long story short, I have been lost in the fog without a compass, using foghorns in order to navigate my way back. Alright, so using sailing as my reference, that's the interesting part about me, is I love sailing. I absolutely love it. Whenever I can get on the water, I would. So now let's get this video back on track to the reason why you tuned in the first place. Let's talk a little bit about portfolio construction. Right now, bonds are in an interesting spot. As we talked about earlier, the Federal Reserve bought a number of bonds. They bought a variety of bonds, mostly treasuries, but they also bought mortgage-backed securities, which is a type of bond. And they're very likely going to be selling those. When they sell them, again, quantitative tightening, they sell those to get them off their balance sheet, but because they are selling, and if there aren't a lot of buyers, then it reduces the price. If it reduces the price, interest rates go up for new replacement bonds. So it's an interesting time in bonds because usually bonds hold up their value when equities or stocks go down. So there's usually that inverse relationship, which hasn't been occurring lately in the first half of the year anyways. Within bonds themselves, of course, I want to recommend diversification of bonds. Why do we own a core portfolio of bonds? Well, we own them for liquidity, diversification, and income. Don't forget that all three of those are important in a portfolio. So I'll wrap it up in a second here. Thank you for tuning in. Of course, remember to like the channel and reach out to me at skybluewealth.com. But returning to the cliche, we will have a combination of choppy weather, thick fog, dark clouds, occasional bright spots throughout the summer, but we do believe that we will have a return to a prevailing wind and clearer skies towards the end of the year.